Hey, what's up guys, Michael here. In today's video I will be talking about the wedges and the flag pattern. So I will discuss where and how to look them on the chart, how to trade them, meaning where to look, where to set the stop losses and potential take profit. And yeah, so this will be basically a tutorial on how to trade those chart patterns. So without further ado, let's maybe dive into the chart, straight into the chart. So firstly, as for the wedges, maybe we'll start from the wedge pattern. There are a couple of things that you need to know in order to trade wedges correctly. The first thing is that they are both either the continuation and the reversal pattern. The situation, if we have right here, signals for us a continuation pattern because we have the rising market over here, and the pattern was, the wedge pattern was created in the opposite direction to the price move. That most of the time signals for us that the price will continue. If we had the situation like this, where we have the rising market and the wedge was created alongside the price, the price direction, it would suggest for us that the price will will reverse. So let's discuss firstly this situation. So what you need to also know about the wedges is that they are created after the significant move, as I said in the beginning, that we will see a pullback on a strong resistance level, and therefore the price will start to form the wedge in the opposite direction like we have here in this situation. But the candles will be getting smaller and smaller, and the range for the price between which will be will be moving is getting tighter and tighter. And when we will draw the lines, you will see what I have on me. So let's take the line tool, mark it along the highs, and the second line, let's mark it along the lows. So as you can see, we have some kind of a wedge, and it is from that moment it started to decline and creating here lower highs, but here it was creating lower lows. But either way, the range where the price was moving was getting tighter and tighter until finally we break through, closed above we can say above the formation, and therefore the continuation started. So the next thing that you should know also is that you should trade those patterns. In my experience, at least, I could say that you should trade those patterns on higher time frames, because it is, as you can see, it is not as very specific, not as a very detailed way where you could enter the market. Because let's be honest, when we have this kind of situation that we have break through this, we have closed above the pattern, and right here at the opening of the second candle we could open. But there are situations like this when, for example, we break through this pattern with one very strong candle, and therefore it is hard to enter the market in such situations. So this is not very precise, and in the tight situations when we have very lower time frames and tight ranges, it is very hard to react and to enter the market. And also we want to have the best risk reward. And as you know, the price is moving up and down all the time, and on the lower time frames there is a lot of market noise, and therefore it is hard to get good entries with I don't know, 3-to-1 or 2-to-1, 1-to-3 or 1-to-2 risk reward ratio. So to potentially earn twice as much as we are risking. So we were discussing this many times on this channel, so you could also check other videos where I was talking about the risk reward ratio. So in this situation, where we look for the entry and where we look for the potential stop loss. So as for the entry, as I told you a second ago, we are waiting for the price to break through and close above this whole formation, and therefore we could enter at the beginning of at the opening of the next candle. So this is the one way. So as for the stop loss, to determine this stop loss level, the ATR indicator could help us. So let's add it to the chart, average true range indicator, and let's make it a little bit smaller. And there are, as I said, it can help us, because if we have situation like this, when the average true range is, for example, at the opening of this candle is 21 pips, that would mean the stop loss would be very tight. So what I am doing in such situations, most often I am targeting, if the average true range is so tight as we have here, I am targeting more or less inside of the wedge pattern. So because there are situations like we have here, when the price reversed a little bit later, but most often the price is retesting the upper boundary of the wedge. Therefore, in this situation, if we use purely the ATR range, ATR true range, it would trigger our stop loss. So I'm always targeting more or less the middle of the wedge formation, because simply if the price would came back to the formation, it would mean that this wedge is was incorrectly interpreted by me, and therefore the price will most likely form something else or will go in other direction. So that is my approach as for the stop loss in this situation. And as for the take profit level, where I am targeting the range from the beginning of the formation. So I am measuring, sorry, I am measuring this level where we have the moment where we started creating the wedge. So we have 68, 60, almost 69 pips. So in this situation, we have something like this. As you can see, it is 2-to-1 risk-reward ratio, 68. And this particular trade was correct. So this is my approach as for trading wedges. Okay, so now maybe let's discuss the flag pattern. And the first difference that you will notice is that the flags are created in a shorter period of time. So let's check some examples. We have those right here. I marked them with the rectangles. So maybe now let's discuss this one. As you can see, here we have the similar time period, but the flag is, the lines, if we will draw them, they are parallel to themselves. So if we will mark them alongside with the bodies, as you can see, it is they are parallel to themselves. So the concept is almost the same as with the wedges, where you should look them. It is surely after the strong significant move, and therefore it should also signal either a reverse or a continuation. So in this situation we have a continuation, therefore, because we have the strong move downward, we have the flag created in the opposite direction to the previous price move. So therefore most likely it signals the continuation. So as I said, when we draw the lines, they are parallel to themselves, and the price range is very tight, as you can see. After a significant move, there is an indecision in the market. The bear in here, the bulls, exactly, the bulls are trying to counter-attack the bears, but they failed. And right here we have the breakout, dodgy candle, and a continuation. So again, the rules are almost the same as with the wedges. The moment where we enter the market is after the closing of the breakout candle and the opening on the next candle after the breakout. And as for the stop loss, the same situation. The ATR could help us. In here we have 25 pips. And so let's measure that. 25 pips. In this situation, it is almost in the middle of the formation, so I would leave this. As for the take profit, most likely it will be very similar to the stop loss, because as you can see, the average true range was ranging in those numbers. So if we measure the distance between the lines, it is 28, 29 pips. So in this situation, I would go for 1 to 2, which means double the range of the stop loss, which is 50. So let's make this measurement 50. And in this situation, this trade a little bit down. And in this situation, the trade would be also profitable, but you need to have that in mind, that there are situations like this when the pullback occurs and the bigger move is a little bit later. So therefore, you should not be greedy and always try to target those 1 to 2, 1 to 3 price ranges. The next example we have right here. Maybe let's delete those rectangles. Again, we have this kind of situation. It would be a wedge because the lines would most likely be converging, but it was created in a very short period of time, so I would rather call it a flag. So let's draw the lines. We have higher lows, and if we mark along the highs, you could see that this is more likely a wedge pattern. But the system is the same. We take the average true range for the stop loss, but yeah, okay. We have the situation where we closed below the formation. We have the doji candle, and we have the opening of this candle, and right here we would entry. So let's check our stop loss in this situation. It is 90.5, so 20 pips. Let's measure that, 20 pips. It is almost in the middle of the formation, so let's leave that, and therefore for the take profit we are measuring the beginning of the formation, the range of the formation. So it is how much? 60 pips. And yeah, we see that this trade was also profitable. So I think that would be all for this video. I hope you understand the concept of the trading with the wedges and the flags. It was a beginning tutorial for beginners, we can say, because there are also wedges that are broadening. For example, let's check. Yes, we have something like this when the wedge is creating by the lines that are broadening, not converging. So there are many stuff to discuss, but it deserves also the separate video. So I think that will be all for this one. Thank you for watching. I hope you liked it. So if you do, leave the thumbs up. Also follow LiteFinance on other social medias like TikTok and Instagram. I'm posting those kind of stuff over there too. So yeah, thank you for watching. Until next time, take care, guys. Bye.